Yeah, thank you everyone, and welcome everyone. Especially thanks to Mr. Anantha Nageswaran for giving his time and sparing and to share with his thoughts. Sir, given the constraint of time, let me just shoot away with my question first before Nayantara can come in. My first question to you, sir, is that post-COVID, if you remove the base effect, actual real rate of growth has been hovering between 0 to 2%, while the inflation has been struggling around 5 to 5.5. Now, this looks somewhat intuitively wrong that despite moving significantly away from the trend growth in GDP, our inflation has not come off. So do you think we have a serious constraint in terms of capacity? And where do you think the potential growth for India incrementally after COVID?
Yeah, that's a good question. Of course, I wouldn't necessarily take a look at the growth rate from 2019 to 20 and then say that, the real GDP growth rate is only up about 2%, but inflation has been between 5 and 6%. And we all know that some of the inflation has arisen globally and in India as well. Initially, last year, it was the impact on wholesale prices, which is now feeding through somewhat into retail prices. And on top of that, we have, energy-related transition, which was held in abeyance for a few months. So I think I wouldn't call it a serious problem. All countries are grappling with both the challenges of maintaining growth rates, while everybody had bounced off the lows of 2020. And in our case, 2020-21. At the same time, inflation issues are coming up because of supply constraints in many commodities and also food items. And now energy has joined the fray. So this is a challenge that is globally present, and India is facing it as well. But I would still like to say that the Indian economic story is a glass that is more than half full, because overall, given the constraints we face, we have managed the fiscal transition and the challenges, the growth dynamics, and also inflation isn't raging as it is in some countries in the Western world. So overall, yes, I agree with you on the characterization of this as serious challenges, but I wouldn't call them debilitating challenges because I believe the glass is more than half full.
So, but still, when we debate internally, we are still not able to figure out what will drive next lack of growth in India over short to medium term, given the constraints and given what's happening on the commodity front, and we are a large importer.
So I think there are two things that can drive India's growth forward. One is, of course, the government has clearly stepped into the plate with its capital expenditure plans. And if you notice in 21-22, based on data available for the first 10 months, even state governments have stepped up their capital expenditure. Second, obviously, consumer demand has been quite subdued because of the 3 waves of pandemic we have had. And let's not forget that the pandemic hasn't fully disappeared from the headlines, as Indians do listen to what's going on elsewhere. So, and you are seeing that, that as the situation in India eases, private consumption demand is beginning to pick up. Probably it is not yet seen in the data. If you just anecdotally observe in the weekends, in shopping complexes and also air travel, etc., there is a distinct pickup in footfalls. And therefore, once that sustains for a couple of quarters, I expect that the capex spending, which is sort of a coil that is waiting to be unwound, that is tightly sprung, will definitely show its full strength, because the private sector ticks many of the boxes that are required for a capital expenditure revival to happen. And the missing box has been the sustained consumer demand revival. And without any further nasty shocks from the COVID pandemic, I think if that doesn't happen, then in the second half of this year, I expect the private capex spending to take the baton from the government and run with it. So this is how I see the growth momentum shifting from one stage to the other.
Okay.
If I could come in here, sir, we've been saying that this is India's decade of growth, and it has to be growth at all costs, right? We've been getting that. If there is one threat that we're having, and you touched upon a little bit, which is consumerism, while we're seeing revenge shopping, revenge dining, revenge travel. So, I'm going to ask a question on behalf of the Aam Aadmi, and that is with inflation, with Mengai, well, how will the government really help? For example, just look at crude oil. You've not even provided any relief when it comes to excise duty cuts. A lot has been said. Is anything going to happen on that front?
I understand it is important to not analyze these things in a piecemeal fashion. If you look at the government, indeed, last week extend the Prime Minister's Garib Kalyan Yojana for another 6 months, and that is 80,000 crores. And even now, the price of crude oil and the energy shock is a global phenomena. And to some extent, if the government were to sort of focus on excise duty reductions as well. And as you know very well, the fertilizer subsidy will naturally be going up because of crude oil prices as well. So on top of the extension of the Garib Kalyan Yojana for another 6 months. Now, if you also talk about energy excise duty cuts on fuel products, etc., then to the extent that it has an impact on the fiscal balances, then the cost of capital would rise, which in turn will affect all kinds of corporate borrowings and also the interest rates that consumers face also. So consumers will face the cost one way or the other. And therefore, that is why I said it's important for us to look at this not in a piecemeal fashion, but holistically.
Sorry. Doctor, but as you said that probably the private capex on the consumption side will pick up, but now incrementally fiscal has to take a back seat, given that our debt to GDP has already reached 90%, and the space for discretionary spending to government is very, very limited. Because there are clear indications that probably we need to keep spending higher on defense, salary, and subsidy part, where we don't have much of space left. So I'll basically ask two questions from this part, which is that, is there any how ready is India for potential next leg of crisis, given our debt to GDP is very high? And second, given that debt to GDP is very high, the capex piece is going to take a back seat. Even in last fiscal year, which is 21-22, government was not able to meet its total capital expenditure targets. So if that is the case, then how can both consumption piece and capex peaks can be a driver of growth over short to medium term?
Look, I mean, there will always be execution challenges, but incrementally, if you look at the last several years, government's actual capex expenditure, even if it has fallen short of the projections, has been on an uptrend. And yes, and to the extent that the government has budgeted for 7.5 lakh crores of capex, which includes 1 lakh crores of interest-free loan to the state governments. And if there are some shortfalls, which may be possible, but nonetheless, the trajectory in terms of actual spend is upwards, and that's important to keep in mind. And several state governments are also improving their quality of capex expenditure. So, I mean, in terms of the budget debt, so the debt dynamic is something that has deteriorated far more in several other countries. And as far as India is concerned, its response to the pandemic in the last couple of years has been one of gradual and calibrated fiscal intervention. So it hasn't overspent and overstretched itself. And much of the increase in the ratio has been due to the denominator shrinking in 2020-21, the GDP. So, and as long as nominal GDP growth lies above the nominal interest rate or its real counterpart, real GDP growth being higher than the interest rate, our debt sustainability is not in question at the moment. So it is going to be, it is very difficult to, in this situation, as the survey pointed out, when shocks are coming one after the other, it is very difficult to give you an unhindered 3 to 5 year path. But what is important is that we remain opportunistic in terms of grabbing growth opportunities. For example, whether it is agricultural exports or whether it is services, IT services exports in the current environment, and also even 2021-22, because of the global rebound from the 2021 contraction, it also helped India's exports to scale $400 billion. So there has to be opportunistic attempts to capture growth dynamics in critical areas, and also carry forward the structural reforms that are needed. Much has been done in that area, from Gati Shakti dashboard to ending retrospective taxation to privatization, etc. And at the same time, continue to provide fiscal support in a targeted way. It is going to be a tightrope walk. That is what many governments around the world are facing. India is no exception. But our track record in the last couple of years or more has been that we are managing this tightrope walk quite competently.
Oh, absolutely. And, taking forward from that, I like, our audience would want to know, the chief economic advisor of this country, sir, we've heard so much about inflation. Is it structural? Is it transient? In your opening answer, you did say, India is doing better than other countries. But ahead of Friday's outcome of the Monetary Policy Committee meet of the RBI as well, our audience would love to know. So where are your views as far as inflation goes? It's dangerously reaching that 6% level. We've still not passed on and seen the full effect of the commodity price inflation as well.
No, I don't comment on monetary policy in public, so I wouldn't say anything about it. But yeah, the inflation outlook is challenging, and we'll all wait and see whether the RBI is going to make any revisions to its growth and inflation projections, because the April meeting is always an important one in terms of setting the tone for the entire financial year. And as the survey also acknowledged, given that the assumptions were made about the oil price being 70 to 75 in the survey, but not in the budget, and given that the average oil price we still don't know yet because the financial year has just barely started. If it turns out that the average price of crude oil is significantly above the assumptions made, naturally inflation will be flirting more in the will be flirting with the upper end of the 2 to 6% range rather than towards the lower end, and therefore the upside risk to inflation is a phenomena that, once again, as I point out, is a global phenomenon. And there are many countries that are having inflation rates that they have not seen in the last 30, 40 years. Yes, we will have an inflation challenge, but that needs to be put in context of what the rest of the world is experiencing as well.
So I appreciate on your thoughts on regarding the monetary policy that you don't want to say onto anything. But as far as the advanced economic central bankers are concerned, they are clearly turning very hawkish at the time when the global growth have very serious headwinds. Even before this Russia-Ukraine situation arrived, Europe, there are clear signs that Europe is very closer, or it may already be in recession. US, at least the bond yield curve and the curvature are indicating that even US can slip into recession probably maybe 12 to 18 months down the line. China is slowing down now, which means that central bankers, for the first time, they are testing markets or maybe testing economic activities by tightening at the time, and the economic activity is slowing at a massive pace. Now, I'd like to hear what's your thought, how tenable it is, or are we getting, or all central bankers pushing this entire paradigm into some bit of stagflation scenario incrementally?
So I'm not sure entirely. I'm not sure I understand the question very well. So developed country central banks, particularly the United States Federal Reserve, has been very clearly signaling, at least in the last couple of weeks or so, that they would look through the supply shock and try to contain the inflation by being quite aggressive. And we have to wait and see what they do in the May and June meetings in terms of both the rate action and their balance sheet reduction or not. So, I mean, and other central, I mean, UK, as we all know, has been already raising interest rates. Australia has signaled a turn. ECB may be still reluctant to follow suit, and Japan hasn't yet. So there are multiple responses there. And the United States has been quite strong in signaling their intent to look past the stagnation aspect, but focus more on the inflation aspect. And I'm sure that the Reserve Bank of India will be cognizant of what is going on elsewhere and position itself accordingly.
Okay, let me just sneak one last question on the bond inclusion part of it, because we hear all sorts of stories, whether we are getting into it or not getting into it. So what's your stand incrementally, and especially the experience that we have seen in last 45 to 60 days? And as such, we have a liquidity situation at our hand that we are in very large liquidity surplus. So beyond the nitty-gritties, has there any change in the view, at least from your side, regarding the bond inclusion part of it by India sovereign?
No, I'm not aware of the developments on that front, so I don't have anything to add on that than what you know already.
Okay. If we have time, probably one more.
Just one last question, please, because somebody came.
Yeah, you have a hard stop, sir. We remember that.
Yeah. So, sir, last question is regarding that Indian current account deficit is now dangerously close to more like 3.5, and this is at least post 2008 and 2013 experience, the policymakers, they gave us a hint that this is kind of a red line from the policymakers. So among the bad policy choices, do you think that in the current macro setup, probably the weaker rupee should be the choice of instrument? And if that is the case, why is that not being used, or it is being now actively considered given what's happening global front?
Again, currency policy rests with the Reserve Bank of India, so I'm not going to comment on that in public. And secondly, as to your point about current account deficit being 3.5% of GDP, that depends on your assumptions about the nominal GDP growth in India as well as the exchange rate. So, I mean, if you look at, even if you assume that the current account deficit in absolute dollar terms turns out to be $100 billion, and if indeed the Indian nominal GDP is around 255 to 260 trillion rupees next year in 22-23, and if the exchange rate is stable at current levels, it will be $3.3 trillion, and in which case the current account deficit will be well below 3% of GDP and not 3.5%. It will be more closer to 2.6, 2.7% of GDP. So a lot depends on our assumptions about how long the oil price will persist at current levels, will it drop, etc. So I think there is no need to necessarily assume that it would be at north of 3%. And that depends on a whole lot of assumptions.
But now if you see,
yeah.
Pardon me for interjecting over there, because we understand how much you have to deal with the kind of volatility, the uncertainty. I don't even know how policy making is possible in these days.
That's
but
right.
the divergence that we're seeing in the bond markets, what the bond yields are indicating, is it a recession or accelerated tightening? And what is happening on ground with the equity markets? So before you go, would love to get your views on the divergence that we're seeing, because that will help us understand where you stand when it comes to the macros.
I stopped wearing the hat of a market strategist, which I was doing in my previous avatar. So I'm not going to comment on the divergence between bond, equity, and currency markets, because that is something I have experienced throughout my career of about quarter century in the financial markets. It has never been the case, whether it is in India or developed markets, that bond, currency, and equity markets send a consistent message. It is not new. So I thank you very much for your conversation. I have to leave, and I wish we could stay long and explore more questions. But thank you once again. I enjoyed the conversation. Thank you.